Okay, let's unpack this. We've got the latest numbers from Bajaj Auto Ltd.
Right. The Q2 and half-year results, ending September 30th, 2025. Unaudited, but still.
And honestly, the material presents a pretty remarkable story, hitting all-time highs.
Exactly, especially when you consider the backdrop. Those global supply chain issues were brutal for many.
So our mission today, really, is to dive deep into these sources. How did they pull this off?
Yeah, how did management manage to accelerate revenue and profit to record levels, especially when key parts like their EV business were facing serious input shortages?
Let's kick off with the headline numbers. Standalone, Q2 FY26. They just smash records.
They really do.
Revenue from operations.
Right.
It almost touched 15,000 crores, came in at 14,922 crores, a new company best.
And that strength flowed right down the P&L. EBITDA, it didn't just hit, it smashed through that 3,000 crore milestone.
First time ever, right?
First time, 3,052 crores. And look at the margin stepping up to 20.5%, very healthy.
Profit after tax, PT, also a new peak. Nearly 2,500 crores. What was the exact figure?
Just shy of it, yeah. 2,479.74 crores.
And this was on volume growth, too.
It was. Total sales volume was almost 1.3 million units. That's up 6% year over year. Solid growth.
So where did that record revenue actually come from? It's quite interesting when you break it down.
Okay.
The sources suggest it's roughly a 50-50 split, you know? Half of it was just pure volume growth, selling more units.
Simple enough. And the other half? That sounds more complex. Richer mix and higher realization.
Exactly. Richer mix just means, well, people are buying the more expensive bikes.
Yeah.
That premiumization trend we need to talk more about.
Got it. And higher realization. Pricing and currency.
You got it. Strategic pricing helped, but critically, currency played a big role in Q2. The rupee weakened.
Providing that tailwind for export.
A massive tailwind. You can see it clearly in the numbers. Their dollar realization per unit jumped.
What did it hit? It was $87.1, up from about $83.8 the year before. That's a significant boost from outside factors.
And that flows right into the margin story, doesn't it?
Absolutely. That EBITDA margin expansion plus 70 basis points just from the previous quarter, hitting 20.5%.
70 basis points is, well, that's a huge jump in this industry, especially now.
It really is, and you have to remember, that was after absorbing some significant cost pressures.
Right, so they were still facing inflation. I thought maybe the currency covered it all.
Oh, no, they were definitely fighting inflation. That 70 basis point gain was the net result. It means they actually offset about 40 basis points of net cost inflation.
Wow. So costs went up, but margins still expanded significantly. What drove the cost increase?
Mostly materials, steel, those expensive noble metals like rhodium and platinum, copper, rubber, the usual suspects. Plus, they consciously stepped up spending on R&D and brand building.
So absorbing 40 points of cost pressure and still adding 70 points to the margin, that points to some serious operational efficiency, doesn't it?
Exceptional efficiency. And operating leverage, of course, from the higher volumes.
Now, here's where it gets really interesting for me. The cash generation.
Always a strong point for them.
They pulled in, what, roughly 4,500 crores in free cash flow just in the first half?
Yep, 40,500 crores. And the conversion rate is key. Nearly 100% of PAT turned into actual cash.
That's incredible. What did they do with all that cash?
Well, they weren't shy about returning it. A huge dividend payout, almost 5,900 crores.
Wow.
And they still managed to push over 2,000 crores into subsidiaries. That's mainly for the KTM deal and boosting their financing arm, BACL.
And even after all that, the war chest looks healthy.
Very healthy. A surplus fund still sitting around 14,244 crores. That gives them, tremendous flexibility.
Just a quick note for you, the listener. When you're comparing these profit numbers year on year, Q2 FY25 PAT might look a bit low.
Yeah, that's important context. The reported PAT back then, about 2005 crores, was lower because of a one-off deferred tax hit.
Something to do with the change in the Finance Act.
Exactly. About 211 crores related to the withdrawal of indexation benefits on certain investments. It was a cleanup from the previous year.
So if you adjust for that, the underlying operational profit growth this year looks even stronger.
Much stronger, yeah. Makes for a fairer comparison.
Okay, let's pivot to the domestic market. Because things were really firing on all cylinders there.
They certainly were. Management points to a kind of perfect storm, really. policy changes, and strong festive mood.
Driving record retail sales.
All-time high retail during that 40-day festive window. And the GST rate cut was a massive, massive trigger for that, combined with the general sentiment.
Yeah, that combo sounds like dynamite for the two-wheeler market.
It absolutely was, but crucially, it wasn't just about selling more bikes. It was about selling better bikes.
Ah, the premiumization trend again. Customers upgrading.
Aggressively upgrading. You see it most clearly with the Pulsar brand. The whole portfolio hit an all-time peak performance.
Which model specifically?
Particularly the 150cc plus sport segment. So think the newer N series and the NS series. They didn't just grow, they handsomely beat the segment's overall growth rate.
So people with money are definitely moving up the ladder.
No doubt. And then you have the KTM and Triumph partnership delivering its biggest quarter ever.
How big?
Domestic retail plus export billing topped 60,000 bikes between them. That's up roughly 70% year on year. Huge jump.
Driven by new launches, too. I saw mentions of a Duke 160 and a Thruxton 400.
Yep. Those new models definitely helped fuel the fire.
But okay, this premium push created a bit of a headache with the GST changes, didn't it? For the biggest bikes.
A major headache. For bikes over 350cc, the tax rate didn't go down, it went up.
Significantly up, right? From about 31% to 40%.
That's right, a 9 percentage point jump. That's a massive hike to pass on, especially at the premium end where competition is fierce.
So the big question for management must have been, pass it on or absorb it?
Exactly. Risk losing your competitive edge in that high margin segment or take a hit on the percentage margin.
And they went for absorption. That seems like a bold move.
Very bold. The sources state they either held prices steady or actually lowered them compared to pre-GST levels on the top end. We're talking KTM, Triumph, Dominar, and that new NS 400 Pulsar.
So they consciously decided to protect market share and, I guess, keep that premium customer pipeline flowing, even if it meant lower margins on those specific bikes initially.
It shows a real commitment to that long-term structural shift towards premiumization in the Indian market. They're playing the long game there. Now, we absolutely have to talk about the crisis they managed to navigate, because these results look even better when you know what was happening behind the scenes.
Okay, what kind of crisis?
A major technical and supply chain disruption. And it hit their fastest growing segment, electric vehicles.
Oh, wow. What happened?
It boiled down to magnets, specifically the availability of heavy rare earth magnets, HREs. These are crucial for the high-performance motors in things like the Chetak scooter and their electric commercial vehicles.
And the impact was significant.
The sources are pretty clear. Chetak supply was apparently running 50% below their plan during July and August. That's a panic moment for any manufacturer.
50% down in your hottest segment. Yeah, that's a full-blown operational crisis. How do they fix it?
This is where their R&D investment really paid off. They managed incredibly to leverage their in-house design expertise to get their entire motor range re-homologated.
Re-homologated, like recertified with a different component, mid-quarter.
Exactly. They had to adapt the motors both for Chetak and the electric three-wheelers to use alternative light rare earth magnets, LREs, instead of the scarce HREs.
Without losing performance. That sounds tricky.
Apparently, they managed it without compromising performance specs. And at the same time, they had to scramble to source these LRE magnets from different regions, different suppliers.
That kind of adaptation, changing core tech and supply lines in just weeks, that shows extraordinary agility, doesn't it?
It really does. Organizational agility at its finest.
And clearly it worked. The bottleneck was fixed by end of September.
Pretty much fixed by end September, fully sorted in October. And the proof is right there in the market data. Chetak immediately jumped back to the #1 spot in Vahan registrations in October.
Wow. Turning a crisis into a comeback story that fast is impressive.
Very. And it underscores the strength they've built in EVs. This isn't just a small experimental division anymore.
No, the numbers suggest it's becoming quite core.
Absolutely. The entire EV portfolio, that's the electric 3Ws, Chetak, and even their stake in Yulu, contributed almost 20% of their domestic revenue in Q2.
20%. That's substantial. And profitable.
That's the kicker. They achieved a double-digit EBITDA margin across that EV portfolio. This isn't just volume, it's structurally profitable business already.
Okay, and what about commercial vehicles overall? Still strong.
Scaling new heights there too, both in volume and revenue. CV exports were up an incredible 67% year on year.
67%. Wow.
And domestically, even with those magnet hiccups affecting the electric CVs, that segment still grew 1.5 times year over year.
They also launched a new e-rickshaw, didn't they? The Riki.
Yes, rolled out in 8 cities initially. That marks their entry into that huge e-rickshaw market.
So the strategy there seems pretty clear.
Yeah.
Cover all bases.
Crystal clear. Build the widest possible fit-for-purpose portfolio. Whether a customer needs a traditional ICE auto rickshaw, an electric auto, or now an e-rickshaw, they want to have the answer, targeting every possible use case.
And that resilience wasn't just domestic, right? The global picture looks strong too.
Extremely strong. Export revenue momentum actually accelerated, up 35% year on year.
Hitting a new record level.
A new pinnacle, yeah.
Yeah.
Close to $600 million for the quarter.
Where was that growth coming from? Any specific regions?
It was pretty broad-based, actually. Strong double-digit growth across their key markets in Africa and Asia. And Latin America just kept powering ahead, setting more records in places like Colombia and Mexico.
Mexico. Let's talk about that. The sources highlighted something significant happening there with tariffs.
Yes, this is potentially a massive long-term advantage. Basically, Mexico has hiked import tariffs significantly for many players, up to 35%.
35% is a huge barrier, but not for Bajaj.
Not for Bajaj. Because of their prior investments, their local setup, and the approvals they secured with the government there, they get to continue operating at just a 5% tariff.
Wait, so competitors face a 35% tariff and Bajaj faces 5%?
Exactly. Think about that differential, a 30 percentage point cost advantage against competitors in a major growing market.
That's not just an edge, that's a structural moat they've built. That should translate directly into market share gains, shouldn't it?
You'd certainly expect it to. It's a huge competitive advantage.
Okay, moving on slightly, the financing arm, BACL. How's that performing?
Also hitting its stride, Bajaj Auto Credit Ltd added over 200,000 new customers just in Q2.
Wow. And the loan book?
Assets under management, the AUM, crossed 14,000 crores and is trending towards 15,000. And profitably, too, Paydi was over 132 crores, up 29% just from the previous quarter. Solid growth engine there.
All right, and finally, the big strategic piece, the KTM acquisition. What's the latest status?
It's moving forward. The subsidiary, BAI-HBV, is going ahead with exercising the call options to buy the remaining 50% stake held by Pure Industries.
So, moving towards full ownership of Pure Bajaj AG, or PBA.
That's the plan, and this fundamentally shifts everything from an accounting perspective.
Right. You mentioned moving from equity method accounting to full line-level consolidation.
Yeah.
Can you break that down for listeners who aren't accountants? What does that actually mean in simple terms?
Sure. Think of it like this. Under the old equity method, Bajaj basically just reported its share of KTM's final profit or loss as a single line item way down in their own results.
Okay, just the bottom line impact.
Exactly. With full consolidation, it's completely different. They'll bring in 100% of KTM's revenue, 100% of KTM's costs, 100% of their assets, 100% of their liabilities, all onto Bajaj Auto's consolidated financial statements.
So the top line, the costs, everything gets much bigger and more complex, but you also get a much clearer view of the combined entity.
Precisely. Much larger financials, yes, but also much more transparency into the operations of the whole KTM business integrated within Bajaj.
And the process is nearly done. Just one regulatory hurdle left.
Almost there. They've got all the necessary approvals except for one final sign-off from the EU.
Which one is that?
It's related to something called the Third Country Subsidies Regulation EU 2022-2560. It sounds complex, but management seems confident.
When do they expect that final green light?
The guidance is by November 10th, 2025, so very soon. They're confident enough that they've already called an extraordinary general meeting for November 19th.
To do what?
To formally change the name of the parent entity over there, Pure Mobility AG, to Bajaj Mobility AG. Signaling the shift is imminent.
Okay, so let's try and synthesize this. What does this all mean for you, the listener, trying to understand this company?
Well, I think the Q2 results really shout one thing above all. Exceptional agility. Maybe even world-class agility.
How so?
Think about it. Swiftly re-engineer motors mid-crisis to overcome a huge supply shock with the magnets. Strategically choosing to absorb a major tax hike to defend premium market share. Effectively leveraging currency movements and exports. They executed incredibly well on multiple fronts under pressure.
It definitely suggests a company that is not just riding a wave, but actively navigating and adapting.
Exactly. It confirms they've built a structurally stronger, more resilient business. They have this diverse portfolio now that can absorb shocks in one area, like the EV supply hiccup, because other areas, like premium bikes and international markets, are firing so strongly.
And those international markets, like Mexico, now has structural advantages baked in.
Right. Deep entrenchment plus that tariff advantage. That's
Um,
powerful.
And looking forward, the big change on the horizon is this KTM consolidation.
Absolutely. That's the next chapter. And the provocative thought, perhaps, for you to mull over is this. Right now, the consolidated results look a bit messy because of how KTM's results are reported with a lag.
Yeah, you mentioned that 6-month loss pickup showing up in Q2's consolidated numbers due to different reporting schedules.
Correct. Once they get full control and move to line-by-line consolidation, that lag, that complexity, it just disappears. The reporting should become much cleaner, much more current.
So the question becomes,
How quickly will the underlying operational improvements they've been working on at KTM become visible on Bajaj's newly consolidated, cleaner top line and bottom line? And what will that clearer picture mean for the overall growth story and perception of the company going forward?
that is definitely the key thing to watch in the coming quarters, a potentially very different-looking set of consolidated financials. Thanks for diving deep with us today.
Always a pleasure. Great discussion.